Introduction to Insolvency, Understanding the Basics. Welcome to our first episode of IO Insolvency Options with Darren Vardy, the Managing Director of Insolvency Options and a registered liquidator with over 30 years of experience helping businesses and individuals navigate financial challenges. In today's episode, Darren shares his journey into insolvency, explains what insolvency actually means, and reveals the warning signs every business owner needs to recognize. We'll explore when to seek help and the difference between corporate and personal insolvency. You'll understand the fundamentals of insolvency, know when to seek professional advice, and learn why acting early gives you the most options. I'm your co-host Anthony Pearl. Let's dive into unlocking more about insolvency options. Darren, I want to talk to you about what I imagine is one of the most uncomfortable topics that you cover, which is around personal bankruptcy. I mean, is that the hardest space to be in because of the emotionalness of it? Because you can dissociate from corporates and businesses, but when it becomes personal, that is hard.
Personal bankruptcy is hard. Whilst I'm not a trustee in bankruptcy per se, so I don't take the trustee appointment. And there's the reason why I think, and not a trustee, is the personal nature of it. Although I do advise individuals on the various alternatives available, and I do hold their hand through the process, which is where I guess I find myself in the helping of people through the process as opposed to the doing process in that instance.
I want to come to some of the alternatives and walking through that in a little bit, but just talk to me, give me the lay of the land for when someone gets into this space where personal bankruptcy is on the table. How do you find yourself there? What does it actually mean?
Look, generally, people will find themselves in a situation of personal bankruptcy where, their liabilities far outweigh their assets. Their liabilities may result from some personal guarantees from business debt. It may result from them operating as a sole trader and not being able to pay their bills and not being run their little sole trading business profitably. It could come from an adverse legal finding and some damages. There are many ways and reasons for individuals finding themselves in a position where their only option is bankruptcy. And in my view, it comes down to, what is the alternatives? Can you avail yourself of the alternatives for bankruptcy, being a debt agreement, a personal insolvency agreement? And if those alternatives aren't available, well, then really bankruptcy is the last cause of action.
So what does it look like for someone if they're in that situation where, personal bankruptcy is the only option? What does it mean? Are they out on the street? Is there...
No. As I indicated, everyone is different. It will all depend on the financial position, whether the individual owns property, whether they do own any assets, whether they're renting. But generally what it means is that any assets that need to be taken into account by a trustee will look at realising those assets for the benefit of the creditors. If there is a house involved, quite often we find that a house is owned by a husband and wife. In circumstances where a house is owned by a husband and wife, we might find that there's a mortgage on it. So when looking at the house, for instance, it may well be that there is very little equity in the house, that another family member or the co-owner may be able to contribute the necessary funds to the trustee for the bankrupt's interest in that property, resulting in the bankrupt and the co-owner not having to sell the property. Yes, in bankruptcy, there are some limitations when it comes to gaining credit and the like, but majority of the time, whilst they have to disclose, people who are bankrupt, they're still able to rent at worst case scenario. They are able to have a motor vehicle up to the prescribed value, which I think is around sort of $9,000 to $10,000. They are able to earn income. And quite often people say to me, what's the limit of the income I can earn? And my response is, there is no limit. You can earn as much income as you can possibly obtain. However, there are some income contribution thresholds where if you go over the after-tax threshold, you have an obligation to pay an income contribution to your trustee in bankruptcy for the benefit of your creditors. And sometimes that is a bit of a misnomer where people think that their income is actually limited, where it's not.
And is that a finite period that they've got that obligation that immediately they might get a job and that job's paying a certain amount, and over a period of time they go up, move up the ladder again, and whatever happens, and they end up in another job that ultimately is paying over that threshold? Is there a period of time before that obligation to pay something back is passed, or is that just there until it's paid back?
So generally, bankruptcy generally lasts for a period of 3 years only.
Uh-huh.
It can be extended if the bankrupt has been non-compliant with their trustee, or if there has been some serious wrongdoing on the part of the bankrupt. However, generally, the majority of bankruptcies last for a period of 3 years, for which a bankrupt will pay income contributions to their trustee if they earn a wage over the threshold.
I imagine that, as you said, that this is such an emotional situation to find yourself in. I gather that the other complexity that happens in all of this is relationships would break up as well as a result of some of this stress in times. And that's only going to complicate things even further, isn't it?
It can do, and particularly where there are kids involved, right? But at the end of the day, the idea is, certainly my focus is to try and minimize that stress on the household and make sure that everyone is fully aware of what's going on and what their rights and obligations are, to get them through that 3-year period and out the other end. And what I quite often say to people is, as soon as you go bankruptcy, that's your time to reset and actually start rebuilding your life, rebuilding your credit rating. So when you come out of bankruptcy, you can show that you've ticked all the compliance boxes throughout the 3-year period, that you've managed to get ahead, and that you're on the path to rebuilding your credit.
Where are we in terms of how common bankruptcy, personal bankruptcy is these days? We've both been around for a while. We've seen interest rates at, ridiculous levels going back a couple of decades. People have talked about interest rates being high in more recent times, but relative to where it was, it's nothing. But have you seen waves of this, or has it remained kind of a constant?
Look, it does come in waves, and certainly through the COVID period and through the period of very low interest rates, it was not as common. We're now finding ourselves in a position where the interest rates, fingers crossed, have topped out for the moment, in May of 25, and we're starting to come back a little. But the impact of those high interest rates, and more importantly, the individuals coming off the very low honeymoon rates into those high interest rates, we're only really seeing that impact on individuals now. And what we're finding is that a lot of people have held out, not dissimilar to business. They've managed to get through until now, but they've exhausted all their resources available and all their reserves. And once the reserves are gone, that's when you find that things get tough within the household. The cash flow isn't there. We're certainly seeing, when you look at realestate.com, there's more properties on the market. It would not surprise me if in certain areas, a lot of properties are on the market given the high value of mortgages relative to the value in certain areas. And that's how we see. So I think, yes, bankruptcies have gone up a little bit of late, but I think that if the period of time goes on and the issues aren't addressed, we'll be seeing some more, unfortunately.
Yeah, I mean, we certainly went through, with, particularly with COVID, that artificial topping up of a lot of businesses through various government funding, lower interest rates at a certain point, and that people were locked into that scenario. And I should point out as well to people, we're in a different situation in Australia to a lot of the rest of the world, aren't we, when it comes to interest rates, that there are a certain amount of people that lock it in for a period of time, and then there's a certain amount of people that just go with the rates at the time there, whereas there are other parts of the world where you're pretty much locked in for the length of the loan. So it's a different scenario, and in many cases can make it a bit more volatile for us.
And that's where we had the very low rates and the honeymoon rates around the 2%. And then by the time that the term of that loan at that rate came off its fixed term, households were then going into the variable rate at the time, which could have been 6%. So all of a sudden, the monthly mortgage payment had more than tripled, which can take a big hit to a household budget.
Yeah, and particularly at a time when everything else is going up as well, because it's not that one thing that just goes up, because you can in a sense deal with it if it was only that one element that goes up. But, food is going up, electricity is going up, everything else along the way is going up at the same time. So the pressure only increases.
The essential services, yes, that's exactly right.
Yep. So let's talk a little bit about the alternatives to bankruptcy, because that's the area that you're obviously trying to guide people in when they're in that situation. So there's a couple of avenues there to go down. Do you want to talk to me a little bit about what those are and how appropriate it is for people to go down those paths?
Sure. The appropriateness of individuals to utilise those paths really depends on the unique individual circumstances. The debt agreement, or the Part 9 of the Bankruptcy Act, not dissimilar to a small business restructure. There is a threshold of liabilities, assets and income. So you have to be below the threshold to avail yourself of that regime. But the debt agreement will look at your income and household expenses, and it looks at the surplus available after all expenses have been taken into account. And then, depending on the level of your liabilities, we'll look at the amount that can be paid from that surplus income toward your liabilities over a period of time. And the debt agreements do run for a period of not more than 3 years, generally. So it's not dissimilar time frame to a bankruptcy. But that's all based upon the amount repayable to your creditors is based upon the surplus income available after payment of all household expenditure. A personal insolvency agreement doesn't have the thresholds mentioned, and generally this is where an individual will make an offer to their creditors to avoid bankruptcy. And that offer will be either from the sale of assets or a contribution from family members and the like, and with the view that that will provide a greater return to creditors than what a bankruptcy would. If a trustee in bankruptcy was appointed, realise the assets of the individual, and then after fees and costs, that surplus is then made available to the creditors. So what that actually involves is a trustee being appointed, investigating, reporting to creditors on what assets are available for realisation, what the return would be like in a bankruptcy, and then submitting the agreement for creditors to approve if they think fit, if they think that, yes, that is a better return through the personal insolvency agreement as opposed to a bankruptcy.
What's the likelihood people going through these paths? Is it generally this is the path that is more acceptable and happens more likely, or is it just so case by case that there's no real?
Unfortunately, there's no rhyme or reason because it is on such an individual case by case basis. But I'm certainly of the view that I'd take the approach that if we can avoid bankruptcy, that's the best approach. And the corollary to that is also there is no use in steering an individual towards a debt agreement or a personal insolvency agreement if we don't think that it would be acceptable by creditors.
Yeah.
Because if we put up an alternative and creditors aren't accepting of that alternative, well, then the default position is bankruptcy. So why take an individual through that emotional roller coaster when we can just, for want of a better term, rip the Band-Aid off, get the bankruptcy started sooner rather than later, because the sooner you start, the sooner you're out, and get them on the road to repairing their financial position and credit sooner.
Yeah, because I can imagine being in such a vulnerable position as facing bankruptcy, you don't want to pin your hopes on something that fails. And that would be such an important stance to be guiding people on and making them feel realistic about whether this is going to happen or not. And do you get a sense before, is there pre-talks with the creditor to say, this is the path we're trying to go down? What do you think before you even get going down it properly? Or is it you just have to put it up and there's nothing you can do till they've looked at it?
Look, there's nothing you can do until creditors look at it. But looking at the mix of creditors, generally you can get a sense on how you think they're going to vote. So, some creditors, for instance, are backed by insurance policies, trade indemnity policies, where if they have a debtor fail, they can then make a claim on their policy for the payment of funds. Generally, where we have that type of creditor, they will not vote for anything other than bankruptcy because they will want to make a claim on their insurance policy to get paid, maybe not all, but certainly a large proportion of the debt. So you really need to have an understanding of the dynamic of the creditor, understanding of the creditor and the dynamic for which they're going to be voting, and then make some calculated assessments from that.
Just to wrap up this discussion on what is a very touchy subject, just on that note, how much of a baggage does that midterm bankruptcy carry with the individual that is in that situation? And for what period of time? Is it the full 3 years? What do you see?
Having not experienced, I can't tell firsthand. It's pretty tough. However, my experience is that people who we've put through the bankruptcy process have come back months later saying how relieved they are that they've actually gone through the process and that it hasn't overly restricted them in their daily life. And based on that, whilst we need to work hard to ensure that they comply with the regulations and make sure that they don't do anything untoward, which will extend their bankruptcy, and make sure that they fully disclose everything. Other than that, a lot of people generally say to me, the phone call stopped. The people that were pursuing the debts have ceased pursuing me because they're now dealing with a trustee in bankruptcy. And sometimes that's all an individual will need, is that little bit of a reprieve from the pursuing creditors to enable them to refocus on their life, what they're going to do to move forward.
Well, that's it for this episode of the IO Insolvency Options podcast. I hope you've got plenty of valuable knowledge and practical steps for whatever your situation is from Darren today. And if you need guidance on insolvency matters, contact Darren Vardy directly at insolvencyoptions.com.au or call 1800 463 328. Or of course, you can connect with Darren on LinkedIn. Details in the show notes below. With over 30 years of experience, Darren and his team provide personalized solutions for both personal and corporate insolvency challenges. This episode was produced by my team at podcastdoneforyou.com.au, helping professionals share their expertise through powerful podcast content. If you found value in today's episode, please like, comment, and subscribe to the IO Insolvency Options podcast wherever you are listening to this. Your engagement helps us reach more business owners who need these crucial insights. Until next time, remember, there's always a way forward when you know your options.